Chris, yeah, I have to say, you've put me to shame here, that dashing tuxedo, your black tie and your champagne. Boy, Happy New Year to you.
Well, apple cider, but that's okay. Happy New Year to you, David. And it really, it's a year that deserves a toast. I'm right there with Larry. I mean, I expected a recession, but we certainly didn't have one. And it's a spectacular year of double digits, 20%. Just amazing.
So what about on the equity side, up over 20% or even up over 40% on the NASDAQ? How much of that was just the anticipation of Fed cuts?
Well, it all happened in the last quarter of the year because really, when you look at the equally weighted S&P 500, that was actually negative back at Halloween and then had a huge rally here at the end. It was really those 7 magnificent stocks. And on the NASDAQ, that really shows up. Best year since 99. Now, that's a lot to celebrate, but wait a minute. Think about 1999. For those of us that were in the market, you can't forget 2001, too. So it was a difficult time. We'll see how this carries through. But what an incredible year for equities. I was wrong. I predicted, David, that the markets would be down this year because, well, gee, the Fed raised interest rates 525%. Should have had a rough market. And let's be clear, the Fed hasn't eased rates, but the bond market has done it for them. You pointed out it's right back where it started the year. But my goodness, the long bond dropped almost 100 basis points since the Fed pivot. That's amazing in such a short period of time.
So what does that say to set up next year, 2024, for you? You have a lot of money at work. How are you taking a look at 2024? How are you positioning yourself?
Well, first, I'm celebrating because thanks to this market, all-time record high for our fund, $327 billion. But I have to tell you, there are certainly dark clouds on the horizon. I think the Fed has pulled off the soft landing, but we still have a lot of risks that we have to get through. And hope does triumph over experience. I know Larry Summers likes to say that it shouldn't, but sometimes it does. And right now, I'm hopeful. I think the Fed's pulled it off. But when you step back and look at this market, we've now created a double top in the S&P 500 in December of 21 and now in 23. As an old-time technician, that makes me a bit worried. That doesn't mean we should have a bear market, but I think a president's election cycle we know in history is at best a low single-digit return in the S&P 500. I would expect, like the elves, barely positive to some of our forecasts that we've looked at are slightly negative. So right now, people's expectations are certainly damped down into next year. I hope the public and the private markets finally open back up because private equity and real estate really had a struggle last year. The markets were almost frozen. We're starting to see a few transactions, but certainly in the commercial office market, values are going to reprice down dramatically. And then in private equity, we're starting to see Merger Monday here in December. Every Monday, a few announcements. That's a good sign that maybe that market will open back up.
So, Chris, I don't want to look at the half-empty part of the glass. I want to continue the celebration you're having there. I endorse it. At the same time, what about inflation? We're so eager to get it behind us. Have we gotten it behind us? And are there some structural factors that might bring it back again?
I think so, David. I think, the Fed has said pretty much they're willing to accept 3%. And one of the first things I do every day is go on the Bloomberg and look at the commodities page and watch where oil is. Now, oil isn't the only driver of inflation, but it's an interesting signal. It's been pretty calm in the 60s and 70s in here. So I think inflation is going to stay where it is in the 3, probably won't get to 2, and Larry Summers can criticize that. But 3 is good enough for the Fed. But it's going to be sticky when I look long-term over the next 10 and 20 years. I think we're going to see spots and spikes of inflation, mostly just due to climate change and disruptions. I mean, look at the Red Sea and the change there, the climate change issues for the Panama Canal. Those things affect shipping prices, and that's an inflation that's embedded well above 2, and the Fed has to decide what they can tolerate.
So, Chris, finally, given all those risks and opportunities, how do you position your fund?
Well, David, we're very neutral at this point to our asset allocation. Now, that means we're long growth, so we like this rally in the market, but we're really not comfortable at this point in taking a big overweight into equities. Non-U.S. was spectacular last year, also high 20% returns out of non-U.S. stocks. So last year was kind of a price to perfection, and this year looks a little tough. There are still two wars going on. Geopolitical risk is at an all-time high. I'll quote Larry Summers, the world's a dangerous place. And so that's got me concerned about taking a lot of excess risk. And I think that while we are at an all-time high, I have a tough time seeing this market having legs. The Magnificent Seven will do what they'll do,
Right.
but I think even they've gotten ahead of themselves. And the bond market has
Right.
overpriced, I think, that Fed rate cut. It's not as aggressive as they expect in March and May.